There is a simple, almost deceptive filter that separates the fortunes of the patient investor from the frantic scrambling of the crowd. It's a principle so fundamental that it governs the natural world, the rise and fall of empires, and the quiet, inexorable accumulation of wealth inside your investment portfolio. It is the one variable that no market wizard can control, no algorithm can predict, and no trader can escape: time. Warren Buffett, in his characteristic folksy wisdom, distilled a lifetime of experience into a single profound observation. Time is the friend of the wonderful business and the enemy of the mediocre one. This isn't just a clever aphorism, it is a razor-sharp tool for executive decision-making in the chaotic world of finance. It is the final promise that can transform your relationship with money, turning the relentless march of the clock from a source of anxiety into your most powerful ally. Most investors spend their lives fighting time. They try to outsmart it, to get in and out before it can expose their mistakes. They buy a stock and check the price a dozen times a day, hoping for a quick pop, a small victory they can cash in. They are impatient with their winners. Conversely, when a stock falls, they hold on for dear life, praying for a recovery, giving a bad business more and more time to corrode their capital. They are patient with their losers. This is a perfect inversion of the winning strategy. The transformation we are about to undertake is a fundamental shift in perspective. You will stop asking, "When should I sell this stock?" and start asking, "Is this the kind of business I am happy to let time work on for me?" By making the quality of the business, not the flickering price on the screen, your primary focus, you enlist the most powerful force in the universe to work for you, not against you. You will build a portfolio that grows not because of your constant tinkering, but because of your disciplined inaction. You will build a portfolio that truly lets you sleep at night, confident that the gears of great enterprises are turning, grinding out value, day after day, year after year. This is the secret to building a fortress of financial freedom, one high-quality brick at a time. To truly understand this principle, we must first build the filter itself. We must learn to separate the wheat from the chaff, the wonderful from the mediocre. Before we can let time work its magic, we have to give it the right material to work with. This brings us to the first pillar of our journey, defining the wonderful business. It's a term that sounds subjective, perhaps even quaint in an era of high-frequency trading and complex derivatives. But it is, in fact, a rigorous and definable concept. And the best way to understand it is to travel back to 1972, to a decision that would forever change the trajectory of Berkshire Hathaway and cement this very principle in Warren Buffett's mind. At the time, Buffett was still largely known as a practitioner of cigar butt investing, a strategy he learned from his mentor, Benjamin Graham. The idea was to find companies trading for less than their liquidation value, like finding a discarded cigar on the street with one good puff left in it. It was a strategy of buying fair companies at wonderful prices. But his partner, Charlie Munger, was relentlessly pushing him toward a different, more powerful idea: buying wonderful companies at fair prices. The perfect test case soon arrived in the form of a family-owned chocolate company from California, See's Candies. See's was put up for sale by the See family, and a broker brought the deal to Blue Chip Stamps, a company Buffett and Munger controlled. The asking price was $30 million. The company was earning about $2 million a year after taxes. To Buffett, the cigar butt investor, this was an outrageous price. It was a multiple of 15 times earnings, far higher than the statistically cheap bargains he was used to hunting for. The company had tangible assets, factories, inventory, storefronts, worth only about $8 million. He was being asked to pay a $22 million premium for something he couldn't see or touch: the brand, the customer loyalty, the goodwill. His initial reaction was to walk away. It was too expensive. But Munger was insistent. He saw something Buffett was still learning to appreciate at a visceral level. He saw a business that was truly wonderful. See's Candies had a fanatical following. For generations, families in California and the American West had made See's a part of their holidays, their birthdays, their celebrations. The simple black and white box was an icon of quality and nostalgia. This wasn't just chocolate. It was a token of affection. Because of this deep emotional connection, See's had something magical: pricing power. Every year they could raise their prices slightly to cover inflation and then some, and their customers wouldn't just accept it, they would happily pay it. They weren't buying a commodity based on price, they were buying a feeling, a tradition. Buffett, persuaded by Munger's logic, went back to negotiate. He and the family haggled and eventually settled on a price of $25 million. Even at this lower price, Buffett admitted he was nervous. He felt he was overpaying, violating the core tenets he had learned from Graham. That $25 million investment in 1972 would become one of the most important case studies in the history of capital allocation. See's Candies, which was earning $2 million a year when they bought it, was soon earning $5 million, then 10, then 30. Decades later, it had generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that required almost no additional capital investment. That $2 billion was then redeployed into other wonderful businesses, compounding the initial gain exponentially. See's became Buffett's prototype, his mental model for a dream business. It was a business so good that time wasn't just a friend. It was a powerful, hurricane-force tailwind. The initial $25 million price, which had seemed so high, was in retrospect an absurdly cheap bargain. The lesson was seared into his mind. The quality of the business was the ultimate determinant of long-term success. This story reveals a profound psychological trap that ensnares most investors. Our brains are not naturally wired to think like Warren Buffett and Charlie Munger did in 1972. We are victims of what psychologists Daniel Kahneman and Amos Tversky called the availability heuristic and the representativeness heuristic. The availability heuristic describes our tendency to overvalue information that is easily accessible. For an investor, the most available piece of information is the stock price. It's right there, flashing in red or green, changing every second. We see a high price-to-earnings ratio and our brain screams, "Expensive!" We see a stock that's down 50% and our brain whispers, "Bargain!" We anchor on these simple available metrics because they are easy to process. The far more important, but less available, information about brand loyalty, corporate culture, and competitive positioning requires deep thought and research. It's not on the ticker tape. Buffett's genius, prodded by Munger, was his ability to ignore the easily available data, the high P/E ratio, and focus on the difficult-to-quantify but critically important data, the love customers had for the product. The representativeness heuristic compounds this error. This is our tendency to judge situations based on how closely they match a familiar prototype or stereotype in our minds. For Buffett in 1972, the prototype of a good investment was a cigar butt, a company with a low stock price relative to its book value. See's Candies did not fit this prototype. It looked, on the surface, like the opposite of a Ben Graham investment. The average investor operates under similar, often subconscious, prototypes. They might have a prototype for a hot tech stock, fast growth, high buzz, no profits, or a safe blue chip, old, big, famous name. When a company is presented to them, they quickly try to match it to one of these mental templates. This is mental shortcutting, a way for the brain to save energy. But in investing, these shortcuts lead directly off a cliff. The path to identifying a wonderful business requires overriding these lazy mental habits. It requires a deliberate, conscious effort to dig deeper, to ask second-order questions. It's not just, is the price low, but why is the price low? It's not just, is the company growing fast, but is that growth profitable and sustainable? By understanding that our brains are naturally inclined to fixate on the superficial, we can begin to build the mental discipline required to see what truly matters, the underlying quality of the business enterprise itself. This is the first step toward aligning your investment strategy with the powerful, patient force of time. So how do we translate this insight into a practical, repeatable process? How can a retail investor, without the resources of a Berkshire Hathaway, apply this filter? We need a mental model, a blueprint for identifying what Buffett calls a, quote, durable competitive moat. A moat is an invisible barrier that protects a great business from competition, allowing it to earn high returns on capital for very long periods. Just like a medieval castle, the wider the moat, the safer the kingdom. There are 5 primary sources of a durable competitive moat, and by turning them into a checklist, we can systematically analyze any business and gauge its quality. The first and most powerful moat is brand power, or what economists call an intangible asset. This was the magic of See's candies. A strong brand allows a company to charge a premium price for a product that is often not substantively different from its competitors. Think of Apple. Is an iPhone's hardware functionally worth twice as much as a high-end Android phone? Arguably not. But the Apple brand conveys status, simplicity, and a seamless ecosystem that millions are willing to pay a significant premium for. To test for this moat, ask yourself the See's Candies question. Can this company raise its prices by 10% this year without losing a significant number of customers to a cheaper alternative? If the answer is a resounding yes, you are likely looking at a powerful brand moat. The second type of moat is high switching costs. This exists when it is expensive, time-consuming, or just plain annoying for a customer to switch from one product or service to another. Think about your bank. Moving all your direct deposits, automatic bill payments, and linked accounts to a new bank is a massive headache. Even if another bank offers a slightly better interest rate, most people won't bother. The switching costs are too high. This creates a sticky customer base and predictable profits. In the corporate world, this is even more powerful. Once a company builds its entire workflow around Microsoft Office or Adobe's Creative Suite, the cost and chaos of retraining thousands of employees on a new system is almost unthinkable. This gives these companies incredible pricing power and a long runway for growth. The third moat is the network effect. This is a special kind of moat where the value of the product or service increases for each user as more people join the network. The classic examples are social media platforms like Facebook or payment networks like Visa and MasterCard. The first person with a telephone had no one to call. The billionth person can call almost anyone. Each new user on Facebook makes the platform more valuable for all existing users. Each new merchant that accepts Visa makes the card more useful for every cardholder, and each new cardholder makes accepting Visa more essential for every merchant. This creates a virtuous cycle that builds an almost impenetrable competitive barrier. A new competitor can't just create a better technology, they have to somehow replicate the entire network, a near impossible task. The fourth moat is a cost advantage. This is the ability to produce a product or provide a service at a significantly lower cost than competitors. This advantage can come from scale, like Walmart's massive purchasing power and hyper-efficient logistics, which allow it to offer everyday low prices. It can come from a unique process, like Geico's direct-to-consumer model that cut out the expensive insurance agent network. Companies with a durable cost advantage can either undercut competitors on price to gain market share or sell at the market price and enjoy much fatter profit margins. Either way, it's a powerful position to be in. The fifth and final moat is a government or regulatory advantage. This is when the government grants a company a special right, like a patent for a new drug, which gives it a multi-year monopoly. It can also be a license required to operate in a certain industry, like a utility or a railroad. These moats can be very powerful, but they are often the most fragile, as they are subject to changes in the political winds. A new law or a court ruling can wipe out a regulatory moat overnight. Therefore, while valuable, they should be analyzed with an extra degree of caution. By using this 5-part checklist, brand, switching costs, network effects, cost advantages, and regulatory protection, you can move beyond the superficial analysis of stock prices and start thinking like a true business owner. You can begin to build a portfolio not of flickering tickers, but of formidable economic castles, each protected by a wide, deep moat. This is the raw material that time can transform into extraordinary wealth. To fully appreciate the wisdom of this approach, we must examine its opposite. We must walk the path of the 99% of investors who, by ignoring the principle of business quality, find that time is their mortal enemy. There are two primary ways this manifests: the siren song of the story stock and the deceptive allure of the cigar butt. The story stock investor is seduced by narrative. They fall in love with a charismatic CEO, a revolutionary technology, or a trend that promises to change the world. They buy into companies in exciting fields like artificial intelligence, electric vehicles, or genomics, often without any regard for current profits, competitive positioning, or valuation. Their investment thesis is based on hope and a compelling story. A classic example is the dot-com bubble of the late 1990s. Investors poured billions into companies like Pets.com, which had a great story, selling pet supplies online, a cute sock puppet mascot, and a Super Bowl commercial. What it didn't have was a viable business model or a competitive moat. It was spending far more to acquire a customer than that customer was worth. Time was its enemy. With every passing day, the company burned more cash, getting closer and closer to insolvency. When the narrative broke and the funding dried up, the stock collapsed to zero, wiping out everyone who had believed in the story instead of analyzing the business. Time exposed the mediocrity, and the result was catastrophic. On the other end of the spectrum is the cigar butt investor, the one who buys a company that is statistically cheap but fundamentally deteriorating. This investor sees a low price-to-earnings ratio or a stock trading below its book value and thinks they've found a bargain. They might buy a struggling department store chain because it looks cheap compared to its historical prices and its real estate assets. But they fail to recognize that the world has changed. Online retail is eating their lunch, their brand is irrelevant, and their stores are bleeding cash. Time is a brutal enemy to this business. Every year, its competitive position weakens. Every quarter, its earnings decline. The book value they thought was a floor turns out to be an illusion, as assets are written down and liabilities mount. Holding this stock is like holding a melting ice cube. The investor thinks they bought a bargain, but they actually bought a value trap. Time mercilessly reveals that a fair company at a wonderful price is often a terrible investment because the underlying business is crumbling. Both the story stock chaser and the cigar butt picker make the same fundamental error. They ignore the quality of the business as their primary filter. They are focused on price, narrative, or superficial metrics. For them, time is a ticking clock, counting down to the moment when the flawed business model is inevitably exposed. For the investor in a wonderful business, time is a gentle rising tide, lifting the value of their holding higher and higher. The difference is not just a matter of degree, it is the difference between wealth creation and wealth destruction. The final and most crucial step in understanding this first pillar is to see how the abstract concept of a wonderful business manifests directly on the financial statements. How does a wide moat translate into tangible numbers that you can see and measure? The answer lies in two key metrics: return on invested capital, ROIC, and free cash flow. Return on invested capital is a measure of how efficiently a company is using its money to generate profits. It's calculated by taking the company's net operating profit after taxes and dividing it by the total capital it has invested, both debt and equity. A wonderful business with a wide moat, like See's Candies or Apple, will consistently generate a very high ROIC, often well above 15 or 20%. They can invest $1 into their business and get a high return profit stream back. This is because their moat protects them from the intense competition that would normally drive down returns. A mediocre business in a highly competitive industry, like an airline or a restaurant chain, struggles to earn a high ROIC. They have to constantly spend huge amounts of capital on new planes or new locations just to tread water. Their returns are competed away. Time is the friend of the high ROIC business because it gets to reinvest its profits at these high rates, creating a powerful compounding effect. Time is the enemy of the low ROIC business because it is stuck on a capital-intensive treadmill, working hard just to stand still. The second, and perhaps more important, metric is free cash flow. This is the cash a company generates from its operations after accounting for the capital expenditures necessary to maintain and grow the business. It is the true owner's earnings. the cash that could be returned to shareholders through dividends and buybacks, or used for acquisitions. A wonderful business, especially one like See's Candies that requires very little new capital to grow, becomes a gusher of free cash flow. The money just pours out, year after year. This cash is the lifeblood of long-term value creation. A mediocre business, on the other hand, often has little to no free cash flow. All the cash it generates from operations has to be immediately plowed back into the business just to keep the lights on and fend off competitors. There is no surplus left over for the owners. By focusing on these two financial indicators, you can see the moat in action. A company with a consistently high ROIC and strong growing free cash flow is almost certainly a wonderful business. The numbers don't lie. They are the financial footprint of a durable competitive advantage. This is how you connect the qualitative story of the moat to the quantitative reality of the balance sheet and income statement. It's how you build a filter that ensures the passage of time will be the most powerful force working for you, building your wealth while you sleep. Once you have mastered the art of identifying a wonderful business, you face a new, and in many ways, more difficult challenge: having the discipline to hold on to it. The second pillar of our philosophy is understanding the power of compounding inertia, recognizing that often, the hardest and most profitable action an investor can take is to do absolutely nothing. This concept is simple in theory, but fiendishly difficult in practice. Our minds and the market environment are constantly conspiring to make us act. The story of Warren Buffett's investment in the Coca-Cola Company is perhaps the greatest lesson in the history of buy-and-hold investing. It's a masterclass in patience. The year was 1988. The market was still reeling from the Black Monday crash of October 1987, when the Dow Jones Industrial Average fell by over 22% in a single day. Fear was rampant. Investors were convinced that the good times were over. Amidst this pessimism, Buffett started buying. He wasn't buying obscure, beaten-down stocks. He was buying one of the most famous and well-established companies in the world, Coca-Cola. Between 1988 and 1989, Berkshire Hathaway invested approximately $1.3 billion to acquire a significant stake in the beverage giant. At the time, Wall Street was skeptical. Many analysts believed Coke's best days were behind it. They saw it as a mature, slow-growing company, not the kind of dynamic investment that would produce spectacular returns. But Buffett saw something else. He saw a business of unparalleled quality. He saw a brand that was not just a brand, but a global icon, synonymous with refreshment and happiness in hundreds of countries and languages. He saw a distribution system that was a marvel of logistics, capable of placing a cold Coke within arm's reach of desire for billions of people. This was a moat of epic proportions, so he bought, and then he did the hardest thing of all. He held. He held through the recession of the early 1990s. He held through the Asian financial crisis of 1997. He held through the dot-com bubble, when Wall Street was laughing at old economy stocks like Coke. He held through the 9/11 attacks and the subsequent market panic. He held through the 2008 financial crisis, a veritable economic apocalypse. He held as new competitors emerged and as consumer tastes shifted. For over 3 decades, his default action was inaction. And what was the result of this disciplined patience? That $1.3 billion investment has grown in value to over $25 billion. But that's not even the most stunning part of the story. The true power of holding a wonderful business is revealed in the cash it produces. In 1988, Coke paid a modest dividend. As the company continued to grow its earnings around the world, it raised that dividend year after year after year. Today, Berkshire Hathaway receives over $700 million a year in dividends from its Coca-Cola stock. Think about that. Every 2 years, the dividend payments alone return the entire original $1.3 billion investment to Berkshire in cash. The rest is pure, unadulterated profit, a torrent of cash flow generated by a decision made decades ago. This is the magic of compounding inertia. By simply identifying a wonderful business and refusing to be shaken out of it, Buffett allowed time to perform a miracle of financial multiplication. He turned a one-time decision into a perpetual money machine, a cornerstone of his strategy for wealth building. The Coca-Cola story is inspiring, but it begs the question, if holding is so powerful, why is it so difficult for most people to do? The answer lies deep within our brain's ancient wiring. We are fighting against powerful psychological biases that have been honed over millions of years of evolution, biases that are terrible for long-term investing. The first and most powerful of these is hyperbolic discounting. This is the formal term for our brain's strong preference for immediate rewards over larger, delayed rewards. A 2004 study by McClure and Leibson at Harvard used fMRI scans to watch people's brains as they made choices between getting a smaller amount of money now versus a larger amount later. They found that decisions involving an immediate reward activated the limbic system, the emotional, impulsive part of our brain. Decisions about future rewards, however, activated the prefrontal cortex, the logical planning part of our brain. This means there is a constant battle raging in our heads between our emotional desire for instant gratification and our logical understanding of long-term benefits. When you see a stock you own is up 20%, your limbic system screams, "Sell it! Lock in that gain! Feel the pleasure of being right now." It's incredibly difficult to override that powerful emotional impulse for the abstract, logical promise of a much larger gain 5 or 10 years down the road. This is why so many retail investors have a portfolio full of tiny winning trades and a few huge losing ones. They cut their flowers and water their weeds. The second psychological hurdle is action bias. As a species, we are wired to believe that taking action is better than doing nothing, especially in situations of perceived risk or uncertainty. Our ancestors on the savannah who heard a rustle in the grass and ran away were more likely to survive than those who sat still and analyzed the situation. Action equated to survival. This instinct is now a massive liability in the stock market. When the market is volatile, our brain tells us to do something. Sell everything, buy the dip, rebalance, change strategies. Anything feels better than just sitting there and watching. Action gives us the illusion of control. The truth, as the Coca-Cola story shows, is that with a wonderful business, inaction is often the most powerful and strategic form of control. It's a conscious decision to let a superior business model do the heavy lifting for you. Overcoming these deep-seated biases requires more than just knowledge. It requires building a system and a temperament that insulates you from your own worst instincts. It requires turning the passive act of holding into a deliberate, active choice based on conviction in the underlying business. To fight these powerful biases, we need a practical set of rules, a protocol that helps us translate the theory of long-term holding into a real-world practice. We can call it the Sit on Your Hands protocol. It's a mental toolkit designed to help you master the art of profitable inaction and build a truly passive income stream. The first tool is the pre-mortem. Before you ever buy a single share of a company, you must take out a piece of paper or open a document and write down the specific, objective conditions under which you would sell. This is not about the stock price, it's about the business. For example, you might write, "I will sell my shares in Company X if 1. They lose their key patent and generic competition enters the market. 2. Management is replaced by a team with a poor track record of capital allocation. 3. The company takes on a dangerous amount of debt for a foolish acquisition. 4. A new technology emerges that makes their core product obsolete." By defining your selling criteria before you buy, you create an objective contract with your future self. When the market panics and your emotions are running high, you can refer back to this document. If none of your predefined conditions have been met, you are forbidden from selling. This short-circuits emotional decision-making. The second tool is the news fast. The financial media is not your friend. Its business model is to generate clicks and views by sensationalizing short-term news and market volatility. Watching CNBC all day or constantly checking stock prices on your phone is like injecting anxiety directly into your veins. It dramatically shortens your time horizon and triggers your action bias. Instead, commit to a news fast. Get your information from primary sources, the company's quarterly and annual reports. Read the CEO's letter to shareholders. Focus on the business results, which are reported 4 times a year, not the stock price, which changes every second. This simple act of changing your information diet will fundamentally lengthen your perspective and improve your investment strategy. The third tool is the too hard pile. One of the greatest secrets to Buffett and Munger's success is not their ability to understand every business, but their discipline in avoiding the ones they don't. Your goal is not to have an opinion on every stock. Your goal is to find a few truly wonderful businesses that you can understand intimately. If you're looking at a complex biotech company or a semiconductor firm whose technology is beyond your comprehension, don't pretend you understand it. Put it in the too hard pile and move on with no regrets. Genuine, deep understanding of a business is the bedrock of conviction. Without that conviction, you will never have the courage to hold on through the inevitable periods of volatility. The final tool is the anti-portfolio, or the too soon sells journal. Keep a separate virtual portfolio of the great companies you sold too early. Track their performance after you sold them. When you see that a company you sold for a 20% gain went on to multiply tenfold, the financial pain of that missed opportunity is a visceral and powerful teacher. It will train your brain to fight hyperbolic discounting. Over time, the evidence of your own past mistakes will provide the motivation you need to hold on to your next great winner. This protocol isn't a magic bullet, but it provides the structure and discipline necessary to build the temperament of a true long-term investor. It helps you get out of your own way and let the power of compounding work its magic. Now, let's explore the antithesis, the path of the chronic trader. This is the reality for a vast majority of retail investors, and it's a cautionary tale of wealth destruction disguised as sophisticated activity. The chronic trader wakes up in the morning and immediately checks the pre-market futures. They have multiple screens with charts, news feeds, and analyst ratings. They listen to the talking heads on financial television, who breathlessly report on every minor economic data point and every rumor of a corporate deal. They feel the need to have an opinion on everything: the direction of interest rates, the price of oil, the political situation in a foreign country. Their portfolio is a revolving door of stocks. They buy a technology company after a glowing news article, only to sell it a week later when a competitor announces a new product. They buy an energy stock when oil prices are high, and sell it in a panic when prices fall. They are constantly rebalancing, taking profits, and cutting losses. But what they are really doing is churning their account. They are engaged in a hyperactive dance of buying high on excitement and selling low on fear. This behavior is not just suboptimal, it is financially ruinous. First, there are the direct costs. Every trade incurs a commission, and while these are lower than they used to be, they add up, acting as a constant drag on performance. More significantly, there are taxes. By selling stocks within a year, the chronic trader pays short-term capital gains taxes, which are taxed at the same high rates as ordinary income. The long-term investor who holds for more than a year pays a much lower long-term capital gains rate. This difference alone can amount to hundreds of thousands or even millions of dollars over an investment lifetime. But the greatest cost is the invisible one: the opportunity cost. The chronic trader never gives a wonderful business the time it needs to compound. They might buy Apple or Amazon, but they sell it after a 30% gain, patting themselves on the back for their cleverness. They miss out on the subsequent 1,000% return that was available to anyone whose only skill was the patience to sit still. The data on this is painfully clear. Year after year, studies by firms like Dalbar, which analyzes investor behavior, show that the average retail investor's returns lag far, far behind the returns of a simple market index fund. The reason for this massive gap is not a lack of intelligence, it's a lack of patience. They are paying a massive self-imposed impatience tax. They are playing a loser's game, mistaking activity for progress and noise for information. They are fighting the tide of time, and the tide always wins. The direct financial connection between holding a wonderful business and building long-term wealth is stark and undeniable. It manifests in two powerful ways: tax efficiency and the miracle of dividend growth. Let's first consider the tax implications. In the United States, if you buy a stock and sell it less than a year later, any profit is considered a short-term capital gain. This gain is taxed at your marginal income tax rate, which for successful professionals and entrepreneurs can be as high as 37% plus state taxes. However, if you hold that same stock for a year and a day, the profit is considered a long-term capital gain. The tax rate on these gains is significantly lower, 0, 15, or 20% depending on your overall income. For a high-income earner, the difference between a 37% tax rate and a 20% tax rate is enormous. Let's imagine two investors. Investor A is a trader who makes a $100,000 profit by skillfully trading in and out of stocks over a year. Investor B buys a single high-quality stock, holds it for a year and a day, and also makes a $100,000 profit. Investor A might pay $37,000 in federal taxes, leaving them with $63,000. Investor B would pay $20,000 in taxes, leaving them with $80,000. That's a $17,000 difference, a direct reward for patience. Now compound that difference over a 30-year career. The patient investor builds a massive, almost insurmountable advantage simply by letting the tax code work for them, not against them. The second, and even more profound, financial connection is the power of dividend growth. Let's return to the Coca-Cola example. When Berkshire Hathaway invested $1.3 billion, the dividend was significant, but not earth-shattering. The real magic happened over the next 30 years. As Coke's business grew, its earnings per share increased. And as earnings increased, the board of directors consistently raised the dividend payout. The key concept here is yield on cost. The current dividend yield of Coca-Cola stock might be around 3%. But for Berkshire Hathaway, the yield on their original cost basis is staggering. They receive over $700 million a year in dividends on a $1.3 billion investment. That's a yield on cost of over 50%. They get back half of their entire initial investment in cash every single year. This is the ultimate form of passive income. This is how you achieve true financial freedom. It's not about the stock price going up and down. It's about owning a piece of a business that becomes a relentlessly growing fire hose of cash aimed directly at your bank account. The chronic trader never experiences this. By constantly selling, they reset their cost basis and their dividend stream. They never get to see the yield on cost mature into those incredible double-digit figures. They are perpetually planting new seeds, never waiting long enough to harvest the mighty oak tree. The combination of tax efficiency and dividend compounding is a financial one-two punch that can only be unlocked by a long-term, buy-and-hold strategy focused on quality companies. It is the mathematical proof that in investing, your greatest asset is not your intellect but your temperament. It is the financial manifestation of time being the best friend of a wonderful business. While time is the great ally of a wonderful business, it is a slow and merciless poison for a mediocre one. This brings us to the third crucial pillar: learning to identify and escape the value traps that litter the investment landscape. A value trap is a company that appears cheap based on traditional metrics like a low price-to-earnings or price-to-book ratio, but is actually expensive because its underlying business is in a state of terminal decline. To truly internalize this lesson, we must turn to one of Warren Buffett's most painful and formative experiences: his initial investment in a failing New England textile mill called Berkshire Hathaway. This is the story of his greatest mistake, the mistake that, paradoxically, became the foundation of his entire empire because it taught him this lesson so brutally. In the early 1960s, Buffett, still operating under the pure Ben Graham cigar butt philosophy, began buying shares in Berkshire Hathaway. The company was undeniably, statistically cheap. The stock price was trading for far less than the company's working capital per share. This meant that if the company were to liquidate its assets, its factories, its machinery, its inventory, shareholders would get more cash back than the current stock price. It seemed like a foolproof investment with a built-in margin of safety. Buffett accumulated a controlling interest in the company and took over management. And that's when the nightmare began. He quickly discovered that he was the captain of a sinking ship. The American textile industry was facing relentless and insurmountable headwinds. Foreign competition from low-wage countries was brutal. The machinery was old and required constant, expensive upgrades just to remain competitive. Labor relations were difficult. For every dollar of profit the company managed to eke out, it had to reinvest another dollar into new equipment just to stand a chance of earning the same meager profit the next year. It was a business that consumed cash, a financial black hole. Buffett described it as a business where you were constantly running on a treadmill, and the treadmill was speeding up. He spent years trying to fix the unfixable, pouring the profits from his other, better investments into propping up the failing textile operations. He later admitted that this was a colossal error, that money, if it had been invested in a wonderful business from the start, would have compounded into a far greater sum. The experience was his crucible. It taught him in the most visceral way possible that the quality of the business trumps the cheapness of the price. He famously summarized the lesson: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The old Berkshire Hathaway textile mill was a fair company at a wonderful price, and time was its mortal enemy. Every passing year, its competitive position eroded further. Every new technological advance made its equipment more obsolete. Eventually, in 1985, Buffett mercifully shut down the last of the textile operations. The name Berkshire Hathaway lived on as the holding company for his collection of wonderful businesses, a constant reminder of the slow poison of mediocrity and the critical importance of focusing on business quality. The Berkshire Hathaway textile story illuminates two of the most powerful and destructive cognitive biases that trap investors in mediocre stocks: anchoring bias and the sunk cost fallacy. Understanding these mental traps is the first step to avoiding them. Anchoring bias is our tendency to rely too heavily on the first piece of information offered when making decisions. In investing, the most common anchor is the purchase price. When an investor buys a stock at $50 a share, that number becomes a powerful psychological anchor. If the stock drops to $30, their brain immediately frames the situation as a $20 loss. Their primary goal often shifts from making a rational assessment of the business's future prospects to simply getting back to even. They will refuse to sell at $30, even if new information suggests the company is in serious trouble, because selling would mean formalizing the loss. They tell themselves, "I'll sell when it gets back to 50. This is a completely irrational way to think. The market does not know or care what you paid for a stock. The only question that matters is, based on what I know today, is this business worth more or less than its current price?" By anchoring to their purchase price, investors chain themselves to their past mistakes, giving a deteriorating business more and more time to destroy their capital. The sunk cost fallacy is a related and equally venomous bias. It describes our tendency to continue with a failing course of action because we have already invested significant resources, in this case, money and time, into it. The thought process is, I've already lost so much on this stock, and I've held it for so long, I can't give up on it now. The past investment of time and money is seen as a reason to continue, even when a rational analysis would suggest abandoning the project. This is the logic of the gambler at the roulette table who has been losing all night and feels they have to keep playing to win their money back. In investing, it leads to people averaging down on a bad business, throwing good money after bad. They are emotionally committed to being proven right, and this commitment blinds them to the objective reality that the business is failing. These two biases create a powerful psychological cocktail that keeps investors trapped in mediocre holdings. They become patient with their losers, hoping for a turnaround that will vindicate their original decision. But hope is not an investment strategy. While they are patiently waiting, time is relentlessly working against them, eroding the value of the business and their portfolio right along with it. To combat these biases, we need an objective system for regularly auditing our holdings. We need a way to answer the question, has time shifted from being this company's friend to its enemy? This is the Business Quality Downgrade Audit, a simple checklist to run through at least once a year for every stock you own. The first item on the checklist is a moat erosion check. Go back to the 5 sources of a competitive moat we discussed earlier and ask if the company's position has weakened. Is its brand losing its luster? Look for signs like declining customer satisfaction scores or market share losses. Are profit margins consistently shrinking? This is a huge red flag that competition is intensifying and their pricing power is fading. Are new competitors with better technology or lower costs entering the field? A moat is not a permanent feature. It requires constant monitoring. The second item is the capital allocation test. This is an assessment of management skill. Read the last few annual reports and CEO letters. Is the company reinvesting its profits wisely into high-return projects that expand its moat? Or is it squandering cash on foolish, overpriced acquisitions that are more about building a CEO's empire than creating shareholder value? Is the company returning excess cash to shareholders through smart share buybacks and growing dividends? Poor capital allocation is one of the fastest ways to destroy the value of a wonderful business. The third and perhaps most powerful tool is the fresh money test. This is a mental exercise designed to shatter anchoring bias. Look at a position in your portfolio. Let's say you own $100,000 worth of company Y. Now ask yourself this simple, brutal question. If I were given $100,000 in cash today, would I use it to buy shares of company Y at its current price? If your answer is an immediate and enthusiastic yes, then you have a good reason to continue holding. But if you hesitate, or if the honest answer is no, then you have a very strong signal that you should sell. The fact that you already own it is irrelevant historical information. Your portfolio should be a collection of your best ideas right now. The fresh money test forces you to justify each holding on its present merits, not on the basis of past decisions. The final item is a debt creep analysis. A strong balance sheet is a key feature of a wonderful business. A deteriorating balance sheet is a classic sign of mediocrity. Is the company taking on more and more debt each year? Is its debt-to-equity ratio climbing to dangerous levels? Often, a business whose moat is eroding will turn to debt to fund its operations or maintain its dividend, masking the underlying decay. This is a fragile situation that can end in disaster if interest rates rise or a recession hits. A careful review of the balance sheet can reveal the slow poison at work long before it becomes obvious to the wider market. By regularly and honestly applying this 4-part audit, you can shift from being a passive, hopeful holder of stocks to an active, disciplined owner of businesses. You can develop the clarity and confidence to sell a mediocre company without emotion, freeing up that capital to be redeployed into a truly wonderful enterprise where time can once again become your greatest ally. The alternative to this disciplined audit is the path of the 99%, the hope and pray strategy. This is the investor who becomes emotionally attached to a stock, often because it was once a market leader or an American icon. They hold on for years, even decades, as the business slowly deteriorates, their optimism blinding them to the harsh reality of the numbers. There is no better case study for this tragic phenomenon than the long, slow decline of General Electric, GE, from the turn of the century. For decades, GE was the quintessential blue-chip stock, a core holding for millions of American families. Under its legendary CEO Jack Welch, It was seen as a model of management excellence and consistent growth. Investors bought it, put it away, and felt safe. It was a wonderful business until it wasn't. After the turn of the millennium, the cracks began to show. The company had become a complex, opaque conglomerate, with a massive and risky financial arm, GE Capital, at its core. The moats around many of its industrial businesses were eroding due to global competition. The company's growth was slowing, and it was relying more and more on financial engineering to meet its quarterly earnings targets. But for the investor anchored to the idea of GE as a great American company, these signs were easy to ignore. They held on. Then came the 2008 financial crisis, which exposed the massive risks hidden within GE Capital, bringing the entire company to its knees. The stock price collapsed. But even then, many investors held on, practicing the hope and pray strategy. They remembered the glory days and believed that a company so big and so important had to come back. They averaged down, buying more shares at lower prices, convinced they were getting a bargain. They listened to the reassurances of management and the hopeful predictions of some analysts. But time was not GE's friend. It was a relentless enemy, exposing the mediocrity that had crept into the business. The company was forced to slash its dividend, sell off its crown jewel assets, and embark on a painful multi-year restructuring. The stock price languished for over a decade, destroying an immense amount of shareholder wealth. An investor who held GE from 2000 to 2020 saw their capital decimated. Meanwhile, an investor who simply owned an S&P 500 index fund during that same period enjoyed substantial gains. This is the devastating cost of loyalty to a mediocre business. The hope and pray investor confuses the company's past with its future. They allow nostalgia and hope to override a clear-eyed analysis of the business's current reality. They give their most precious asset, time, to a company that is squandering it. It's a slow, painful financial death by 1,000 cuts, a perfect illustration of why recognizing and acting on business deterioration is just as important as identifying quality in the first place. Finally, we must see how this slow decay, this poison of mediocrity, is reflected in the cold, hard numbers of the financial statements. A deteriorating business leaves a clear trail of evidence for anyone willing to look. Unlike a wonderful business that gushes cash, a mediocre one is a sponge that soaks it up. The first place to look is the income statement. A healthy, growing business will show consistent top-line revenue growth. A mediocre business will often have stagnant, or, even worse, declining revenues. This is the most obvious sign that its products or services are losing relevance with customers. Next, look at the profit margins. A company with a strong moat can maintain or even expand its gross margins, the profit left after accounting for the cost of goods sold, and its operating margins. A business under competitive pressure will see these margins shrink year after year as it's forced to cut prices or spend more on marketing to keep its customers. Look for trends. Is selling, general, and administrative expense, SG&A, growing faster than revenue? This can be a sign that the company is having to spend more and more just to stay in the same place. The ultimate sign of mediocrity on the income statement is, of course, a trend of declining net income. The most powerful evidence, however, is often found on the cash flow statement. As we've discussed, a wonderful business generates strong and growing free cash flow. A mediocre business often shows the opposite. You might see that cash from operations is flat or declining. Even worse, you might see that capital expenditures, the money spent on maintaining and upgrading assets, are consistently high, eating up all the cash the business generates. This is the financial profile of the old Berkshire Hathaway textile mill. It's a business that runs hard just to stand still. A company with negative free cash flow year after year is, by definition, destroying value. It is consuming more cash than it produces. Time is its mortal enemy, as it needs a constant infusion of new capital, either from debt or by issuing new shares, just to survive. By comparing the financial profiles of a company like Microsoft, with its high margins and massive free cash flow, and a company like the struggling GE of the 2010s, the difference becomes stark. One is a value-creating machine, the other a value-destroying treadmill. The numbers provide the objective verdict. They allow you to cut through the narrative, the hope, and the emotion, and see the business for what it truly is. They are the tools that give you the courage to sell your losers and reallocate your precious capital to businesses where time is a friend, not a foe. We have now established how to identify wonderful businesses and how to shed mediocre ones. But between these two actions lies a vast, treacherous landscape of human emotion. The fourth pillar of our philosophy is about conquering this internal enemy. It's about understanding and overcoming the behavioral urge to do something, an impulse that leads investors to sell their winners too early and panic during market downturns. We must learn to manage the impatience tax. There is no better illustration of the required temperament than the actions of Warren Buffett and Charlie Munger during the darkest days of the 2008 financial crisis. As the global financial system teetered on the brink of collapse, the prevailing emotion was pure, unadulterated terror. The stock market was in freefall. Storied institutions like Lehman Brothers were vanishing overnight. The media was filled with images of panicked traders on the floor of the New York Stock Exchange, and headlines predicting a second Great Depression. For the average investor, the instinct, the overwhelming, gut-wrenching urge, was to sell everything, to convert their stocks to cash and hide until the storm passed. But at his desk in Omaha, Nebraska, Warren Buffett was calm. He was not reacting to the fear. He was analyzing the opportunity. He understood that the panic was creating once-in-a-generation bargains in wonderful, if temporarily troubled, businesses. In September 2008, just days after Lehman's collapse, he announced a $5 billion investment in Goldman Sachs, one of the most prestigious investment banks in the world. He didn't just buy their common stock. He negotiated a brilliant deal for preferred shares paying a 10% dividend, plus warrants to buy common stock at a very attractive price. A year later, he made a similar $5 billion investment in Bank of America when it was also facing immense pressure. These were not impulsive actions. They were the culmination of a lifetime of patience. Buffett often says the stock market is a no-strike game. You can stand at the plate and watch thousands of pitches go by. Overvalued stocks, complex businesses, speculative fads, and you don't have to swing. But every once in a while, the market's manic-depressive mood swings will serve up a fat pitch, an opportunity so good that it's hard to miss. The 2008 crisis was a whole inning of fat pitches. The key was that Buffett and Munger had cultivated the psychological fortitude to wait for this moment, and the courage to act decisively when it arrived. They were not trying to time the absolute bottom of the market. They were simply recognizing that they could buy great financial franchises at prices that made no sense unless you believed the entire capitalist system was about to end. And then, after making these investments, they were patient once again, holding on as the fear subsided, and the true value of these businesses was recognized by the market. Berkshire Hathaway made billions of dollars from these crisis-era investments. The story is a masterclass in emotional control. While the world was succumbing to its most primitive instincts of fear and flight, Buffett and Munger were operating from a different playbook, one based on logic, patience, and a deep understanding of business value. They demonstrated that the greatest profits are often made not during the bull markets, but by having the courage and liquidity to act when there is blood in the streets. The behavior of the crowd in 2008 is a textbook example of two of the most powerful biases in behavioral finance: loss aversion and herd behavior. To cultivate the temperament of a great investor, we must understand how these forces work on our minds. Loss aversion was first demonstrated in groundbreaking experiments by Daniel Kahneman and Amos Tversky. They found that, psychologically, the pain of a loss is approximately twice as powerful as the pleasure of an equivalent gain. If you find a $100 bill on the street, you'll feel good. If you lose a $100 bill from your wallet, you'll feel absolutely terrible, and the negative feeling will be far more intense than the positive one. This asymmetry has profound implications for investors. When the market starts to fall, and investors see the value of their portfolio declining, the pain they feel is intense and disproportionate. Their brain's threat detection system, the amygdala, lights up. The instinct to make the pain stop by selling becomes almost overwhelming. This is why people panic sell at the bottom. They are not making a rational calculation about the future prospects of their investments. They are making a visceral, emotional decision to stop the immediate psychological pain of seeing more losses. Herd behavior is the natural human instinct to follow the actions of a larger group. For our ancestors, this was a crucial survival mechanism. Sticking with the tribe meant safety. Wandering off alone could mean death. This instinct is still deeply ingrained in our social DNA. In the financial markets, it means that when we see everyone else selling, our brain tells us that must be the safe and correct thing to do. The fear of being left behind, or the fear of being the only one holding on while everyone else rushes for the exits, is immense. The financial media amplifies this effect, with headlines about waves of selling and investor panic, creating a feedback loop of fear. Buffett's famous maxim, "Be fearful when others are greedy, and greedy when others are fearful," is a direct prescription for fighting these two biases. It is an instruction to use the herd's emotional stampede as a contrary indicator. When the herd is euphoric and greedy, driven by the pleasure of easy gains, that is the time for caution. When the herd is terrified and panicked, driven by the intense pain of loss aversion, that is the time for courageous action. This is easy to say but incredibly difficult to do. It requires developing a level of emotional detachment and intellectual independence that is rare. It requires having more faith in your own research and judgment than in the collective mood of the market. It is, in essence, a rebellion against your own human nature. Cultivating this contrarian temperament is not something you are born with. It is something you build through discipline and the use of specific mental models. This is the Temperament First Investor Framework, a set of principles to guide your thinking and protect you from emotional errors. The first principle, borrowed directly from Charlie Munger, is invert, always invert. Instead of asking, "How can I make the most money in the market?" ask the inverted question, "What are all the ways I could lose money, and how can I avoid them?" This simple flip in perspective is transformative. It shifts your focus from chasing speculative gains to avoiding stupid mistakes. The path to long-term wealth is not about hitting home runs. It's about avoiding strikeouts. By focusing on what not to do, don't buy businesses you don't understand, don't use leverage, don't trade frequently, don't panic sell. You will automatically outperform the vast majority of investors who are constantly making these unforced errors. The second principle is to live and die by your circle of competence. Only invest in businesses that you can understand so deeply that you could explain how they make money and why they have a competitive advantage to a 10-year-old. This is not about being smart. It's about knowing the boundaries of your own knowledge. If your expertise is in retail, focus on retail companies. If you're a software engineer, you have an edge in understanding technology businesses. By staying within your circle, you develop genuine conviction. This conviction is your armor during a market panic. When the stock of a company you truly understand falls by 50%, you are more likely to see it as a buying opportunity because your faith is in the business, not the stock price. If you own a stock you don't understand, a 30% drop will feel like a confirmation of your ignorance, and you will be tempted to sell. The third and most famous mental model is to internalize Benjamin Graham's allegory of Mr. Market. Imagine you are partners in a business with a man named Mr. Market. Every day he comes to you and offers to either buy your share of the business or sell you his, at a specific price. The key is that Mr. Market is a manic depressive. Some days he is euphoric and quotes a ridiculously high price. Other days he is despondent and offers to sell you his share for pennies on the dollar. You are completely free to ignore him. You are not obligated to trade with him at all. This brilliant allegory reframes market volatility. The stock market is not a source of wisdom, it is a source of prices. Its mood swings are there to be exploited, not to be followed. When Mr. Market is pessimistic and offers you a bargain, you can buy. When he is euphoric and offers you a silly price, you can sell. And on all the other days, you can simply go about your business, confident in the value of your holding. This mental model turns fear into opportunity and greed into a warning sign. The final tool is the use of a decision journal. Before making any investment decision, buying or selling, force yourself to write down, in detail, exactly why you are doing it. What is your thesis? What are the key variables? What are the risks? What is your expected outcome? This simple act does two things. First, it slows you down, creating a crucial gap between the emotional impulse and the action. Second, it creates an honest record. Months or years later, you can go back and review your decisions. You will quickly see the patterns in your thinking, especially the times when your reasoning was based on emotion rather than logic. This feedback loop is one of the most powerful tools for improving your decision-making process and building a more rational, patient temperament over time. To fully grasp the importance of this temperament, we must examine the futile and destructive path of the market timer. The market timer is an investor who believes they can outsmart the market's short-term movements. Their goal is to sell at the very top, just before a crash, and buy back in at the very bottom, just before a recovery. It is a seductive fantasy, the idea of capturing all of the upside while neatly sidestepping all of the downside. The problem is that it is virtually impossible to do consistently over time. To be a successful market timer, you have to be right twice. You have to be right about when to get out, and you have to be right about when to get back in. The emotional challenges are immense. Getting out at the top means selling when the market is euphoric and everyone else is buying, a feat of extreme contrarianism. Getting back in at the bottom means buying when the market is in a state of terror and every headline is predicting doom, a feat of extreme courage. The historical data on this is brutal. Numerous studies have shown the devastating cost of being out of the market on its best days. For example, a 2021 Bank of America study looked at stock market returns from 1930 to 2020. It found that if an investor had stayed fully invested in the S&P 500 throughout that entire period, they would have earned a handsome return. However, if they had missed just the 10 best trading days in each decade, their return would have been almost zero. The vast majority of the market's long-term gains are concentrated in a very small number of explosive upward moves, often immediately following a period of panic. Consider the investor who, terrified by the COVID-19 pandemic, sold all of their stocks in March of 2020. They successfully timed the crash, locking in their losses but feeling smart for avoiding further pain. But then, the market staged one of the fastest and most ferocious recoveries in history. Our market timer watched in disbelief from the sidelines. They were too scared to get back in. They thought it was a dead cat bounce. By the time they finally felt it was safe to reinvest, months later, the market had already surpassed its previous highs. They missed the entire recovery. They sold low and bought high. The cardinal sin of investing. This is the fate of almost every market timer. They pay the ultimate impatience tax, not just in the form of poor returns, but in the form of immense stress and anxiety. The long-term, quality-focused investor, in contrast, simply held on through the 2020 crash, secure in their ownership of wonderful businesses. They did nothing, and they were rewarded handsomely for it. They understood that the secret to navigating market volatility is not to try and dance in and out of it, but to have a portfolio that is robust enough to endure it. The direct financial consequences of impatience versus patience are staggering, and they can be quantified through two concepts: volatility drag and opportunity cost. Volatility drag is a mathematical reality that punishes the trader and rewards the holder. Imagine a stock starts at $100. In year 1, it goes up 50% to $150. In year 2, it goes down 50%. The average return seems to be zero, so you might think the stock is back at $100. But it's not. A 50% loss from $150 is $75. The stock is now at $75, down 25% from its starting point. This is volatility drag. The more a portfolio fluctuates, the more this mathematical drag eats away at its long-term compound return. The chronic trader who is constantly buying high and selling low is maximizing the volatility of their portfolio and therefore maximizing the effect of volatility drag. The patient, buy-and-hold investor who owns stable, high-quality businesses minimizes this effect. Their smoother ride to wealth is not just psychologically easier, it is mathematically superior. The far greater financial impact, however, comes from opportunity cost. As the data on missing the market's best days shows, the real money in investing is made over the long term, and much of that return is front-loaded into the recovery phases after a downturn. The impatient investor who sells during a panic is almost guaranteed to miss this recovery. The cost of being on the sidelines during these crucial periods is not a few percentage points. It can be the difference between a comfortable retirement and a constant state of financial struggle. Think of it like a journey by sea. The market timer tries to get off the ship every time they see a storm on the horizon. The long-term investor builds a sturdy ship, a portfolio of wonderful businesses, and stays on board, knowing that storms are a natural part of the journey and that over the long run, the prevailing winds are at their back. The market timer spends their life in the harbor, stressed and going nowhere. The patient investor endures some rough seas but ultimately reaches a prosperous destination. The numbers on a brokerage statement at the end of a lifetime will reflect these two profoundly different approaches. One will show the high costs and low returns of fear and activity. The other will show the quiet, powerful, and massive rewards of patience and discipline. We have now assembled the core components of our philosophy. We know how to identify wonderful businesses, how to shed mediocre ones, and how to cultivate the temperament to hold on for the long term. The final pillar is to synthesize these ideas into a cohesive, holistic strategy. It's about moving from individual decisions to building a complete portfolio architecture designed for generational wealth. This is the portfolio as a time machine. The perfect case study for this final pillar is not a single investment, but the entire evolution of Berkshire Hathaway itself. The company's journey is a living testament to the power of structuring a portfolio around the principle of time. As we know, Berkshire started as a failing textile mill, a quintessential mediocre business where time was the enemy. Buffett's early investments, made through the holding company, were a collection of cigar butts and other special situations. The portfolio was a hodgepodge of disparate, statistically cheap assets. But over the decades, a profound transformation occurred, driven by the intellectual shift from cheap to great. A shift heavily influenced by Charlie Munger. Buffett began a decades-long process of masterful capital allocation. He used the cash flow from his existing investments, including the dying textile mill, to buy wonderful businesses. First came the insurance companies, like National Indemnity, which provided float, premium money that could be invested for Berkshire's benefit. Then came the outright purchases of truly great enterprises, See's Candies, the Buffalo News, Nebraska Furniture Mart. Later, he made massive investments in public companies with wide moats, like Coca-Cola, American Express, and Wells Fargo. In more recent decades, the transformation became even more dramatic with the acquisition of huge, capital-intensive but incredibly durable businesses like the BNSF Railway and Berkshire Hathaway Energy. The portfolio evolved from a collection of small, fair businesses into a fortress of world-class, wholly-owned operating companies, supplemented by a concentrated portfolio of large positions in public stocks like Apple. What Buffett built was a system, an economic machine designed to harness the power of time. The cash generated by one wonderful business, like C's, was systematically redeployed to purchase another wonderful business, like BNSF. It became a self-reinforcing flywheel of value creation. Berkshire Hathaway today is not just a collection of assets. It is a carefully constructed ecosystem where capital flows from its least promising uses to its most promising ones, with Warren Buffett acting as the chief capital allocator. The company itself is the ultimate proof of the thesis. It is a portfolio structured to have time as its unassailable ally, an engine designed to compound capital at a high rate for generations to come. To build our own version of this time machine, we must first overcome the final set of psychological biases that lead to poor portfolio construction, the endowment effect and mental accounting. The endowment effect is a close cousin of anchoring bias. It's our tendency to place a higher value on something simply because we own it. In a famous experiment, one group of participants was given a coffee mug and then asked for how much they would sell it. Another group was not given a mug and was asked how much they would pay for one. Consistently, the owners demanded a much higher price to sell than the buyers were willing to pay. The mere act of ownership created an emotional attachment that inflated the perceived value. For investors, this means we are naturally reluctant to sell a stock we already own, even if it's mediocre, to buy a new, more promising one. We overvalue what's already in our portfolio. Mental accounting is the habit of separating our money into different psychological buckets. We might have a safe money bucket, bonds and blue chip stocks, a retirement bucket, our 401k, and a play money bucket for speculative stocks. This feels organized, but it can lead to irrational decisions. A holistic, time-centric approach requires breaking down these mental barriers. Your portfolio should be viewed as a single, dynamic entity. Every dollar of capital, regardless of which bucket it's in, should be constantly evaluated against all other potential opportunities. The goal is to ensure that your total pool of capital is always invested in the collection of businesses that you believe have the best long-term prospects. This means being willing to sell a safe but mediocre stock from one bucket to fund the purchase of a wonderful, growing business for another. It requires a ruthless, unemotional focus on optimizing the long-term compounding power of your entire net worth, not just managing individual mental accounts. Overcoming these biases is the final psychological step toward becoming a true capital allocator, a CEO of your own personal holding company. With the psychology aligned, we can now lay out the blueprint for the generational compounding portfolio architecture. This is a practical, actionable strategy for structuring your investments to make time your most valuable employee. The first step is to adopt a core satellite approach. The core of your portfolio should consist of a concentrated number of wonderful businesses, perhaps 5 to 15, that you understand intimately and believe have durable competitive moats. These are your fat pitch investments, the companies you intend to hold for decades, if not forever. This concentration is crucial. It forces you to do your homework and only invest in your absolute best ideas. It is the opposite of the diversification practiced by most investors. This core is the engine of your time machine. The second step is to build your satellite or farm system. This is a carefully curated watch list of other high-quality businesses that you have researched and admire, but that are currently trading at prices you consider too high. Your job is not to watch their stock prices every day. Your job is to continue studying their businesses, reading their annual reports, and understanding their competitive landscape. You are patiently waiting for Mr. Market, in a moment of panic or pessimism, to offer you one of these great businesses at a fair price. When that opportunity arises, you will be prepared to act decisively. The third component is a strict capital flow discipline. The default action in this system is always to do nothing, to let your core holdings compound. However, you must have a clear plan for the rare exceptions. When a core holding suffers a clear and permanent erosion of its moat, as determined by your business quality downgrade audit, you must sell it with discipline. Similarly, If a stock becomes so fantastically overvalued that its future returns are likely to be poor, you can trim or sell the position. The crucial rule is that the proceeds from any sale must be immediately redeployed into the single best opportunity available at that moment, which will likely be one of the businesses from your well-researched farm system. This creates a closed-loop system where capital is constantly, if infrequently, flowing towards higher quality and better long-term returns. The final piece of the architecture is the annual letter to yourself. Once a year, sit down and write a formal letter to your future self. In this letter, you must articulate, for each of your core holdings, exactly why you continue to own it. Restate the investment thesis. Review the business's performance over the past year. Reassess the strength of its moat. This act of writing forces a level of intellectual honesty that is difficult to achieve otherwise. It prevents you from holding the stock simply out of inertia. It ensures that your reasons for ownership are based on a sound, logical analysis of the business quality, not on hope, nostalgia, or an anchor to your purchase price. This simple habit is one of the most powerful tools for maintaining a long-term, business-focused perspective. This complete architecture, core satellite, a farm system, capital flow discipline, and an annual letter, transforms your portfolio from a random collection of stocks into a coherent, strategic enterprise designed to achieve one specific goal: the maximum compounding of wealth over the longest possible period of time. Let us now visit the antithesis of this disciplined architecture, the diversification portfolio. This is the tragic state of most individual investment accounts. The owner of a diversified portfolio typically holds 50, 100, or even more different stocks and mutual funds. If you ask them why they own any particular one, they likely can't give you a coherent answer. They bought some based on a tip from a friend, others from a list of hot stocks in a magazine. They bought a handful of mutual funds based on their 5-star rating from Morningstar, with no real understanding of the underlying strategy or holdings. They believe they are following the principle of diversification, which they've been told is the only free lunch in finance. But what they have actually achieved is the opposite. True diversification is about owning a collection of uncorrelated assets to reduce risk. What they have built is a closet index fund. By owning a little bit of everything, their portfolio's performance will almost perfectly mirror the market average, but with one crucial difference. They are paying much higher fees. They pay trading commissions, and they pay the high management expense ratios of the dozens of mutual funds they own. These fees act as a constant, guaranteed drag on their returns. But the biggest problem with the diversified portfolio is that it has no engine. The few wonderful businesses that might be hidden within it are completely canceled out by the legion of mediocre and terrible businesses they also own. Time cannot help this portfolio, because its effect is neutral. The wealth created by the great companies is simultaneously destroyed by the poor ones. The owner of this portfolio has no conviction. Because they don't truly understand what they own, the first sign of market turmoil will cause them to panic. They have built a portfolio for stagnation and anxiety, not for long-term growth and peace of mind. They have mistaken owning many things for being safe, when in fact they have guaranteed themselves mediocrity. It is a portfolio built by accident, not by design, and it is a financial boat with no rudder, no sail, and no destination. The direct financial connection of the generational compounding architecture is the culmination of our entire journey. It is where all these principles converge to produce a tangible and massive financial advantage. The goal of this strategy is the deliberate and systematic generation of alpha, the term for returns that are above and beyond the market average. By concentrating your capital in a small number of truly outstanding businesses, you give yourself a mathematical chance to significantly outperform the market indices, which by definition are composed of both wonderful and mediocre companies. This is not a guarantee, but it is a logical possibility that is completely absent in a diversified portfolio. More importantly, this outperformance is achieved with far lower frictional costs. Your trading commissions will be minimal, as your turnover is extremely low. Your tax bill will be dramatically reduced, as the vast majority of your gains will be long-term. You will spend less time, less energy, and less emotional capital worrying about the market's daily gyrations. The result is not just a larger portfolio, it's a better quality of life. The portfolio ceases to be a source of stress and becomes a source of security and passive income. The growing stream of dividends from your collection of high-quality businesses can eventually replace your active income, giving you the ultimate prize: financial freedom. This is the end game. To create a portfolio that is so well-structured, so aligned with the forces of time and quality, that it becomes a true time machine. It is an engine that takes the input of time and converts it directly into wealth, allowing you to live your life on your own terms. It is the final promise of this philosophy, the transformation of your relationship with money from one of active, anxious pursuit to one of patient, prosperous ownership. It is the single filter that makes your portfolio grow while you sleep. You have just invested a significant amount of your most valuable asset, your time, to fundamentally rewire your understanding of how wealth is truly built. You've moved beyond the noise of the market and grasped a powerful, timeless principle. You now possess the mental filter to distinguish a wonderful business from a mediocre one, and you understand that this distinction is the key to making the relentless passage of time your greatest financial ally, not your enemy. You have acquired a tool that can protect you from the costly mistakes of impatience and the psychological traps that ensnare the vast majority of investors. This is not just theory. It is a practical blueprint for building a fortress of financial security. But what you've just mastered, as powerful as it is a single crucial piece of a much larger intellectual puzzle. Warren Buffett's system of thought is not a collection of isolated tips. It is a deeply interconnected network of mental models. The principle of using time as a filter is connected to his models for valuation, for assessing management, and for understanding your own psychological limits. You have just forged a powerful link in the chain, but the chain is not yet complete. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in your journey. Think of the knowledge you have just gained as a detailed map of a single, wealthy province. The video on the screen is the map to the adjoining province, the one that contains the missing link, the piece of the system that connects everything you just learned to the next level of mastery. The choice you face right now is more than just a click. It is a decision about who you want to become. The average person will stop here, satisfied with this new piece of knowledge, and drift off to watch something entertaining. But you are not the average person. You are on a path of deliberate self-improvement, of building an unassailable mental arsenal for success. To click away now is to leave the fortress half-built. To continue is to add the next layer of stone to the wall, to complete the next circuit in your thinking. The question is simple. Will you settle for having one piece of the map, or will you commit to revealing the entire blueprint for financial sovereignty? Continue your ascent. Click the video. Complete the arsenal.